You got paid, and somehow you're still not getting ahead. You try to save, you try to be disciplined, but months pass and nothing really changes. And if you don't fix it now, you'll wake up 5 to 10 years later with the same bank account, just older. Here I'll show you exactly how to start investing from zero, using a strategy that actually works today, not 10 years ago. The mistake beginners don't even realize, they think investing starts with money. It doesn't. It starts with control. Because if your money is leaking, investing becomes meaningless. You've already seen this pattern in your own life. You get paid, then slowly the money disappears. Subscriptions, convenience spending, impulse buys. Money doesn't explode, it leaks. And here's the uncomfortable truth. If you can't control $1,000, you won't control $10,000 either. So before we talk about stocks, ETFs, or crypto, we fix the foundation. Step 1. Build a system, not discipline. Discipline sounds strong, but it fails under stress. What you need is automation, because the real goal is simple. Money should move without you thinking about it. Here's the modern beginner setup. Income arrives. A fixed percent instantly goes to investing. A fixed percent goes to savings. The rest is for living. Because leftover money doesn't exist. Stop asking, how much should I save? Start asking, how do I build a system that makes money without me? Security, freedom. Without a goal, saving feels like punishment. A lot of beginners delay investing because they think, I'll start when I have more money. That sounds logical, but it's completely backwards. You don't invest because you have money. You invest to create it. Even $25 per week matters. It's about building the machine. The real wealth is built by combining fast money, crypto, trading, hype assets, passive income, dividends, cash flow, long-term investing, index funds, ETFs, not choosing one. Let's break down what actually works today. Layer 1, the core, your foundation. This is where most beginners should start. Index funds. Think of them as a basket of hundreds of companies. Instead of guessing winners, you own the whole system. This reduces risk and increases consistency. It's one of the few strategies that has survived every market cycle. And here's why it works. The economy grows over time, businesses expand, innovation continues. You're not betting on one company, but on progress itself. But the first phase is slow. Very slow. Because in the beginning, you are the main source of growth. That's why the first $100,000 feels impossible. Layer 2. Acceleration. Today, many investors are shifting toward dividend strategies, cash flow assets, income-focused ETFs, because people don't just want wealth anymore. They want income without working, and this is where dividends come in. Imagine getting paid without doing anything. It's ownership. Dividend investing is powerful, but beginners often misuse it. They chase high yields, look for quick income, and they ignore risk. For example, some high-yield assets promise 10 to 20% returns. Sounds incredible, and they can generate strong income, but often the price drops, the dividend gets cut, or the risk is much higher than expected. High yield often equals high risk. Here are limited upside, market sensitivity, and sometimes unstable payouts. So the smart move is not avoiding them, it's using them carefully. Balance yield, quality, and sustainability, not just numbers on the screen. Layer 3, the multiplier. Now we get to the most important concept, compounding. This is where the dividend reinvestment plan strategy comes in. Instead of taking dividends as cash, you reinvest them automatically. That means more shares, more dividends, even more shares. And the cycle repeats, like a snowball rolling downhill. Why this matters more today than ever? In previous decades, people relied on pensions, stable jobs, government support. Today, you are your own pension. And the fastest way to build that is automated investing, reinvestment, time. Because once your portfolio grows, the market starts doing the heavy lifting. A 10% return on $5,000 is nothing. A 10% return on $100,000 changes your life. Let's talk about what's actually growing right now. Forget hype for a second. Let's look at reality. Over the last few years, the market has changed in a very specific way. 1. Technology is no longer optional. It's infrastructure. AI, automation, cloud systems. These are not trends anymore. They are foundations. 2. Energy is transforming, not disappearing. Traditional energy still matters, but renewables and efficiency are growing fast. 3. Real estate is evolving, not just houses, warehouses, data centers, logistics. These are the new backbone. 4. Income is becoming more valuable than growth alone. People want cash flow, not just paper gains. A smart modern portfolio doesn't pick one direction. It blends growth for future wealth, income for stability and freedom, safety for survival during bad times. Let's break this into something practical. 1. The core, 60 to 70%. This is your base. Broad index funds, total market exposure. S&P 500 index funds focuses on the biggest companies. Global index funds, you invest in the whole world. US plus Europe plus Asia plus emerging markets. Bond index funds, this is for stability and protection. Your long-term engine. You buy one fund and it owns almost everything. You don't touch or trade this. You let it grow. Because over decades, this is what carries you. 2. The growth boost, 15 to 25%. This is where you lean into the future. Sectors like technology, AI-related companies, innovation-driven businesses, higher potential, higher volatility. This is where wealth accelerates, but only if controlled. 3. The income layer, 10 to 20%. This is your cash flow engine. Dividend stocks and ETFs are REITs, income-focused ETFs, because eventually you want them to pay you. That's the difference between being rich and being financially free. The real game? Increasing your inputs. Investing alone will not make you rich early. At the beginning, your growth comes from your income, savings rate, consistency. That's why increasing income matters. Side work, skills, better opportunities. Because the faster you reach critical mass, the faster compounding takes over. You don't need to outperform the market. You need to stay in the market, stay consistent, avoid mistakes. Because most people lose not from bad strategy, but from bad behavior. You can invest for years and still end up with nothing. At some point, your portfolio starts growing. You think, now I understand investing. And overconfidence leads to bigger risks, worse decisions, and eventually, losses. Mistake number 1, chasing what's already popular. This cycle repeats every few years. Something goes up fast, everyone talks about it, you feel late and jump in. Crypto, AI stocks, hot sectors. But by the time it feels safe, most of the growth is already gone. Don't chase attention. Stay patient. Mistake number 2, stopping too early. You invest for 1 to 2 years and don't see massive results, so you slow down or even stop. And this is exactly why most people never reach real wealth. Because compounding needs time. A lot of it. If you quit before momentum, you never actually invested. You just tried. Mistake number 3, lifestyle inflation. This one destroys more wealth than bad investments. You earn more, so you spend more. Better apartment, a new car, more comfort. And suddenly, you're still stuck, just at a higher level. Let's simplify the real path to financial independence. Phase 1, foundation, 0 to 10,000, build habits, invest consistently. Phase 2, accumulation, 10,000 to 100,000, increase income and stay consistent. Phase 3, momentum, 100,000 to 500,000, compounding becomes visible. Phase 4, freedom, 500,000 plus. Investments generate real income, the number that matters more than net worth. Not how much you have, but how much your money produces. Because $1 million with no income equals pressure, $500,000 producing income equals freedom. That's why income-focused strategies matter later. Stay in the game long enough. Time does the heavy lifting. At first, you control your money. Then, your money starts controlling your future. You realize you're no longer working for income. Income is working for you.